bad, right? This is where we all want to be one day and where we want to guide our clients. Clients like Anna. That's why we've put together this guide. Consider it your and Anna's map to Retirement Island. So, Anna, when you make money, do you pay taxes? When you spend money, do you pay taxes? When you save money, do you pay taxes? After you're gone, might your heirs have to pay taxes? So, as we're planning for your retirement, doesn't it make sense to try to save money on taxes? Excellent. When it comes to taxes, you've got 3 choices. Tax deductible, like paycheck deductions, business expenses, and usually mortgage interest. Tax deferred, you save money now but pay tax on it later. And income tax free. Which one sounds best to you? Of course, 99% of our clients want tax-free. Their next choice is usually tax-deferred. But after completing CFNAs, guess what we found? 99% of people own tax-deductible and tax-deferred. Good question. Why would people buy tax-deductible and tax-deferred if they want tax-free? Because someone sold them those products rather than educating them on a better way to save. Let me show you what I mean. What's your favorite fruit? If you sold $1 worth of apple seeds and you're in a 25% tax bracket, you'd pay 25 cents tax, right? And if you sold a whole harvest of apples, $100,000 worth, you'd pay $25,000 in taxes. Let's back up a bit. If you pay taxes on the seed, you'll get the harvest tax-free. If you defer the taxes on the seed, you have to pay taxes on the harvest. 25 cents or 25,000? Which would you rather pay? Unfortunately, people with tax-deferred products like 401ks, IRAs, 403bs, etc. will pay taxes on the harvest. They'll pay on the money they saved and all of the growth. I'll show you in a second just how much that can be. You might want to sit down for that. But first, let's look at the only 3 programs in America today that allow us to save after-taxes money, grow it tax-deferred, and use it tax-free. First, municipal bonds. Are you familiar with those? They're sold municipality improvements, such as roads. They take time to mature. They presently have low returns. And based on your situation and time horizon, this may not be the best product for you. Then there's a Roth IRA. Are you familiar with those? They're qualified accounts, same as an IRA except for you put your money in after tax. Your money grows tax-deferred, and you can use it tax-free. The downside is that the government dictates how much you can put into it, how you can use it, and when you can use it. Most people don't like government hands in their money. Do you? The third option for tax-deferred growth and tax-free income is life insurance. Life insurance is one of the most misunderstood financial instruments in America. Why do most people buy life insurance? Right, to protect their families. People that don't understand the power of life insurance usually want the most insurance for the least amount of money, right? Hold that thought. People who really understand life insurance know it's a superb vehicle for savings, and they try to get the least death benefit while putting as much money into their policy as possible. They know the money they put in grows, tax-deferred, and they can use it tax-free. So, Anna, let's use life insurance as the vehicle that'll take you to your retirement island. Before we take that trip, let's review how America invests. Americans save their money in fixed accounts or in equities. For the sake of this conversation, let's just say that equities are any products in the stock market. Why do people put money in the stock market? Right, upside potential. They try to get big returns. But are those returns guaranteed? Or can investors lose their money? Do you like losing money? Well, then maybe the stock market is not for you. Another option is fixed accounts, like those found at banks and credit unions. These could be checking accounts, savings, CDs, or money market accounts. They all have 2 things in common. They're considered safe and have low returns, so they may not be the best option. So, what are we supposed to do? Take a huge risk in the stock market or make no money with the banks? There actually is a better option. We call it the best of both worlds, otherwise known as indexing. Indexing gives you the fair share of the upside potential of the market and protects you from losses. So now you combine the indexed savings account with the life insurance that provides tax-deferred growth and tax-free income, and you have an IUL, Indexed Universal Life. So Anna, when you have a 401k, stock account, or checking account, do you usually pay fees? Well, this product also has fees in the form of cost of insurance, COI. Anything you put into the policy over the COI grows up to the cap annually, and once it's credited into your account, you do not lose that money. You know what else is great about IULs? They are lawsuit-proof, judgment-proof, and creditor-proof in many states. Your money is safer than in your checking account, investment homes, or other accounts that might be vulnerable to these types of claims. Your money is safe. Ready for that trip to Retirement Island? You'll need a big boat. Really big. What's your favorite color? And how about a name? Nice. So the Antonio is ready to sail. But what if he has no motor? How quickly could you get to Retirement Island? Not very. How about now? With this tiny trolling motor, how fast will you get there? Maybe never. But how about these? That's a lot of horsepower. Now we're really moving to Retirement Island. The more power you put into your policy, the quicker you'll get there. So let's take a look at how a pre-tax product compares with the IUL to see if it's the right vehicle for you. Anna, where's your money right now? Say you've saved $500,000 over time in your 401k. During your first year of retirement, you take out $100,000. If you're still at a 25% tax bracket, the first thing you'll do is send the IRS $25,000. You and your family can use the other $75,000, and you have $400,000 left in your account. If you had that $500,000 in an IUL, you could pull $100,000, your family could use $100,000, and you don't pay taxes, and you still have $500,000 in your account. The insurance company doesn't send you money from your account. They loan you the money. You don't pay the money back. It's discounted from your policy upon death. Another difference between your 401k and an IUL. Say the S&P gained 10% this year. You'd get 10% of your $400,000 balance and would have $440,000. Okay. But in an IUL, you'd get 10% of $500,000. Nice, right? Let's keep going. In the second year of your retirement, you take out another $100,000 from your 401k. There goes another $25,000 to Uncle Sam. You've now paid how much in taxes? And your account sits at $340,000. Another $100,000 from an IUL? Yep, no taxes. And your balance is still $550,000 and growing. Another 10% year in the market, and the IUL climbs to $605,000. The 401k, you get that same 10%, but that only gets you to $374,000. Seems like one keeps growing and one is falling. Which one do you want for your family? Would you like to get your financial plans on track? Click the link below for a free consultation.